there, future CMAs. Welcome to today's Explainer. I am absolutely thrilled to be working with you today. We're going to tackle a pretty foundational topic for your CMA Part 2 exam prep, specifically right inside that financial statement analysis section. We're mastering comparative financial statement analysis and zooming right in on common-size statements. Look, I know the syllabus inside and out, and my goal today is just to make this concept crystal clear for you. We're going to get you walking into test day with absolute confidence. Here is our quick 5-step game plan for today. We'll start with the size effect problem, define vertical analysis, crunch some numbers together, look at a classic exam trap, and then finish up with some live exam practice. All right, kicking things off with Section 1, the size effect problem, comparing companies. So let's dive into why we even need common size statements in the first place. You know, when you first open a massive company's financial statements, seeing literal billions of dollars in revenue, inventory, and long-term debt, well, it can feel totally overwhelming. It's completely normal to feel a bit of anxiety about that sheer scale. I mean, how on earth do you compare a behemoth like Apple to a small, agile tech startup? Or even for a smaller business, how do you know if your own company's cost structure is actually improving if your sales are just constantly fluctuating up and down? Raw numbers alone just kind of fail us here. They don't tell the whole story. Moving right along to Section 2, defining vertical analysis. This brings us to our primary tool, which is an absolutely elegant solution to the size effect problem. Common size financial statements are the main mechanism for what we call vertical analysis. Now, why vertical? Well, just picture looking straight up and down a single column of financial data for a single period. You're taking every single line item in that column and expressing it as a percentage of one specific base item on that exact same statement. It basically takes all that messy, intimidating raw data and standardizes it into really clean, easily comparable percentages. The absolutely crucial point here is knowing what that base item is. As your teacher, I need you to memorize these 2 golden rules right now for the exam. Seriously, lock these in. First, if you're looking at an income statement, your base item, your 100% mark, is net sales, which is sometimes called total revenue. So every expense, your gross profit, your net income, it's all just expressed as a percentage of net sales. Second, if you are on a balance sheet, your base item is total assets. And since assets equal liabilities plus equity, every single line item on that sheet is expressed as a percentage of that total assets number. Now, don't let this formula freak you out. Take a look at it. It might seem intimidating at first glance, but notice how incredibly simple the math actually is. Your common size percentage is literally just your specific financial statement line item divided by your base item and then multiplied by 100 to get a percentage. That is the whole shebang. No complex calculus, just basic division that totally eliminates that size effect problem we talked about. All right, Section 3, crunching the numbers, step-by-step math. Let's move from theory into practice here. We've got an income statement for company X. We're looking at net sales of $1 million, cost of goods sold at $600,000, which leaves a gross profit of $400,000. We subtract $250,000 in operating expenses, and we land at a net income of $150,000. Okay, those are our raw dollars. Based on those golden rules we just talked about, if we want to convert this, what must our base item be? Exactly, it's our net sales of $1 million. Now watch the magic happen. We just divide every single item by that $1 million net sales base. 1 million divided by 1 million means net sales is our perfect 100%. Our COGS at 600,000 divided by a million becomes 60%. Gross profit becomes a 40% margin, operating expenses become 25%, and our net income sits at a really clean 15% margin. We have successfully converted the whole thing into standardized percentages. And this visually illustrates the real power of what we just did. Think of your net sales as the whole donut, right? At 100%. It is perfectly sliced up. 60% went to making the goods, 25% went to operating the business, and 15% is our bottom line profit. Because these are percentages now, if some massive rival company has $50 million in sales, we literally don't have to care about their raw dollars anymore. We can just put their gross profit percentage right next to company X's 40% and immediately know who is operating more efficiently. It's a real game changer. Which brings us to Section 4, the classic exam trap. Don't get tricked. Okay, lean in for a second because the ICMA absolutely loves to set traps on test day. And this is a big one. They will frequently try to confuse you by mixing up vertical analysis, which is what we're learning today, with horizontal analysis. So let's clarify. Vertical analysis, or common size, goes straight up and down a single column. The base item is in the exact same period, and you're analyzing the financial structure. Horizontal analysis, though, moves across, left to right. It compares a line item over multiple years to a base year to evaluate growth trends over time. Remember, if the exam asks for percentages within the same period, it is always vertical analysis. Let's put this to the test. Section 5, Live Exam Practice. Test your mastery. You know the rules, you know the math, you know the traps. Let's do a real exam-style scenario. Target Co. reports total assets of $2 million, current assets of $500,000, net sales of $4 million, and net income of $400,000. In a common-size balance sheet, what percentage should be assigned to current assets? Just take a quick second to process those numbers. All right, let's walk through my foolproof 4-step methodology to solve this. Step 1, identify the statement. The question specifically asks for a common-size balance sheet. Step 2, find the base. For a balance sheet, our golden rule says the base is total assets, which is $2 million here. Step 3, and this is absolutely crucial, ignore the distractors. They threw in net sales and net income just to bait you into using income statement rules. Ignore them. Step 4, calculate. We take our line item, current assets at $500,000, and divide it by our base, total assets at $2 million. $500,000 divided by $2 million gives us 0.25 or 25%. Boom. It is incredibly easy when you stick to the steps. Let's do a quick wrap-up before we go. Remember, common-size statements are synonymous with vertical analysis. Your income statement base is net sales, and your balance sheet base is total assets. Doing this completely eliminates the size effect, letting you compare companies of literally any scale. You are doing fantastic work preparing for Part 2. Honestly, I highly recommend you hit your test banks today to practice this while it's super fresh in your mind. So you've totally mastered vertical analysis and understanding the structure of a single period. But that does leave us with an important question. How will you spot the financial trends that happen over time? I mean, how do you track growth year over year? Well, next time, we're going to tackle exactly that when we dive into horizontal analysis. Keep pushing, stay confident, and keep studying hard.